Welcome back. We are here with another webinar, and these series of webinars actually aimed at giving you the skill set of applying the knowledge and writing your own answers, especially exam support session. And before I start, I would like to connect this with my previous session. There was a special lecture that I conducted, especially if you look at the screen. There was a syllabus change in this subject. There were new learning outcomes that were introduced, which are going to be effective from July 21. And then as a part of this lecture, I have, when I say this lecture, previous session, I have given you extensive summarized coverage, maybe about 2-hour webinar. So please make sure you have watched it. And because I always say that whenever I happen to cover ABR, that in this paper ABR, especially today's topic, I am giving more attention to 25% of the syllabus called risk of material misstatement, right? So this part of the syllabus, essentially, if there is one key chapter that I am going to take you through today, and if you look at some of the topics that have been categorized under this risk of material misstatement. Now, other thing that I want to clarify with the previous session that I did, and the syllabus change, what institute is looking, this part of the syllabus is more from auditing lens. Therefore, in this revised learning outcomes, it is specifically mentioned that how auditor is going to use auditor's risk assessment procedures to identify risk of misstatement. Therefore, you should be aware about some of the auditing standards that auditor is using for the purpose of risk assessment, which I covered in the previous webinar. To identify, assess risk, especially risk assessment new auditing standard. This is a revised auditing standard that has a wonderful framework for risk assessment. Especially I explain this as TUCUMS, 2 C's, UMS. These are very powerful elements of risk assessment. So one C is complexity, right, change, uncertainty, management bias, and subjectivity. Now, by looking at these characteristics, you are going to identify risk. So, one of the very important points that I want to make, when you identify risk, what are the risks that you are identifying? It is nothing but about financial statements. We are looking risk of material misstatement in relation to financial statement. What is there in the accounts? You have account balances, transactions, so we say classes of transaction and disclosures, right? In any of these, we are studying ROM, especially when we study ROM, right? We are looking 2 things, inherent risk and control risk, right? And to understand both inherent and control risk, you need to really understand the concept of assertion. So there are several webinars that I have covered. You know, if you look at the series of webinars on ABR, this section, these topics have already been covered. So I don't want to repeat, but this lecture is specially about application. How do you analyze a case study and come up with your own answer confidently, and so that in the exam that you, without any fear, can complete answers. Right, complete your answers. So, the big message that I want to give you, right, when you identify inherent risk, let us say that is due to subjectivity. That subjectivity may be an account in estimates, and that account in estimates may be impairment, and that in turns relating to USLFRSs, right, the LKS 36, right, the impairment standards, and then the fair valuation, right? In the impairment, you are going to use fair valuation, so the fair valuation standard. So the big message is that when you have a very good understanding about accounting standard, SLFRSs, that is a must for you to analyze risk of material misstatement. So, if I am not mistaken, the coverage about SLFRS is about 35% of the syllabus. Now, together you can see the big part, right, that is covering about 70% of the syllabus, right. So, that is where you have to be very strategic, right, how to use accounting standard knowledge to easily analyze a case study in this part of the syllabus. So, that is for that purpose I have selected a very detailed comprehensive case study from your revision kit, and we are going to analyze that case study. And before I analyze, I will also remind you some of the key concept that we covered in the previous lecture, so that you are able to see how theory connects to case study. So, when you look at these slides, especially through this case study, I will mention make sure that while you watch the webinar, and if you wish to have, you can have your study text and revision kit open, and through the case study that I am going to do, it is going to cover, right, this critical topic. One is business risk, which I covered in the previous lecture, and then how to connect business risk to risk of material misstatement. Then the risk of fraud is another topic that is covered through this case study, and a going concern, again I did going concern in my previous session when I did with the syllabus revision session, right. But then this case study is a holistic case study that covers many of these areas. So, this is the whole story of risk assessment that we discuss, and you can see how inquiries, manage inquiries, analytics, observation, inspection, the various procedures auditors are doing, which are aimed at understanding the entity, right. And I have given para references. Now, understanding what? So, auditor has to have a very good understanding about the company, right, the company's environment. So, that environment relates into industry, the organization structure, the governance, business model, how do they make money, and how IT system integrated. Is there a website, right, is the website connected to revenue generating model, and the industry, whether industry competition is intense, how that competition can result in pressure, what are the regulation in the industry, and then what are the KPIs. So, when you have understanding about these elements, right, you are better able to identify this. For example, you see there is a sales commission arrangement, and most of the senior managers remuneration, the significant part of the remuneration has a commission. So, now they are under pressure to achieve commission, and that pressure can create a fraud risk. And then similarly, this understanding has to cover the accounting standard, which are particularly relevant to standard. That is why I said now here applicable financial framework simply refers to accounting standard, and then this is what I mentioned to in my words, TUCUMS, right, 2 C's UMS in the new standard is called inherent risk factors. And then with these factors, audit is able to identify financial statement risk as well as assertion level risk. And especially new auditing standard has given a new explanation to significant risk. Significant risk means those risks which are at the upper spectrum. Now, spectrum means you draw like a, you know, if you want to draw a line, right, now risk start with a low risk, medium risk, high risk. So, the risks which are in the upper end of the spectrum, those are called significant risks, right. So, this is the definition for which assessment of IR is close to the upper end of the spectrum of IR due to the degree of IRF factors. Now, you know what IRF factors, therefore, the possibility of misstatement and the size of the misstatement is high. Let us say revenue recognition is complex in one entity, like I mentioned in my previous example, revenue recognition in telco is complex, and that complexity, right, has created a risk of misstatement in revenue which is likely to happen, and revenue is material. Therefore, auditor may identify that as a significant risk. Having said that, some auditing standard has particularly commented or mention that certain risks are significant by nature, especially 540 auditing standard that deals with accounting estimate. And I am going to just show you a key chapter that while you are preparing for ABR, it's very important that you carefully cover study text content, right. In the study text, the 540 standard is covered, and then the 550 related party transaction can also be a significant risk, and what I covered in the previous webinar, the going concern is also considered as significant, right. Similarly, there can be significant risk in group auditing context and things like that. Then in this whole story of risk, what is very important is business risk. Now, this is the definition given for business risk. Right. Now, if you look at the risk definition, I mean, this is a very quick revision of what we have discussed, but we have to recap this theory before we get into the case study. A risk resulting from significant, see this word condition, right. Now, there is a significant financial issue in the company that put a lot of strain for the company to continue, that is the condition, or a significant event like COVID-19 or a debtor going bankrupt or a litigation, right, significant event condition or any circumstances, right, or company's action, the company is going to copy the technology of the competitor, that is action, and company's inaction, the technology is changing, company is not doing anything. Right. Now, these can affect company's ability to achieve objectives and execute strategy. Now, you can look at the slide, the words that I have highlighted. This definition you can find in study text as well as auditing standard. Another thing which is mentioned in study text, which you have to be well aware, is the distinction between strategic risk and operational risk. Right. So, there are two aspects. One is a strategic risk. When it comes to risk, right, one division is some risk. Now, these are more of business risk we are talking, right. Some risk you call, you can term as strategic risk. I mean, that can affect the survival of the business. Now, again, strategic risk in the study text, you can see it has been articulated that some risk, okay, I will explain to you that division, and then some risk are called operational risk. Perhaps in a case study, you may be asked to identify separately strategic risk and operational risk. Forget any notes, just forget. But you have to be a very practical student. What is a strategic risk? Strategic risk can have a significant long-term impact on the company, whereas operational risk can have an immediate impact on the day-to-day operation. So, then give an example. That is how good practical student will look at the subject. Now, if you take an example for strategic risk, that maybe there is a concern that the company's new product is going to fail. That is a strategic risk. So, then when I say new product, it relates to the market as well as company's ability to come up with a product at a competitive price. That is a strategic risk, right. And then if you take operational risk, that is, remember this definition, if you Google operational risk now, you will find interesting definition from Basel III, and that is the definition for many textbooks. The operational risk definition is the risk of loss arising from three things, right. Inadequate or fail people, process, system, PPS. Inadequate or fail people, sometimes people fail to follow instruction, right. The process fail, there is a failure in quality system, as a result the defective product has been released to the market, right, and then suddenly system fail. Now, let us say in a company suddenly machines stop working, right. Now, then you have to stop the production, people not coming to work perhaps, people are not supervising the quality. Now, these are operational risks. So, this is also important because I am covering that part of the theory before I get into the case study. So, I will just show you some of these things that we discuss now, and make sure in your study you extensively cover this chapter, chapter 26, and in my previous webinars I have covered this theory part of what is a risk of misstatement, assertion, in giving you very detailed explanation, but now I am drawing your attention to the topics in study text, right. The true and fair view here is about the concept of true and fair view, and that is where the true and fair view arises, right? When the financial statements are prepared based on applicable financial reporting framework in our country, SL1 if financial statements comply with recognition, measurement, disclosure requirements of SL1, that financial statements give true and fair view. Then now see, I am without looking any pages, I am just talking by looking at 7 topics listed in your chapter. So you have to understand true and fair view. When you break the concept of true and fair view, you need to connect it to FRF. What is FRF? Financial reporting framework. In simple, if company is not following the standards, right, that may result in the true and fair view is affected. So then misstatement is the comparison of company's recorded number, if you compare with what should be recorded based on SL1, that's called a misstatement. Now there are 3 misstatements. When you go through this chapter, you will see the 3 misstatements. Some misstatements you can say for a fact revenue is understated. You find that the wrong rate has been used, that's factual. And some is judgmental. Some misstatements are judgmental. For example, auditor's assessment of impairment is different from company's assessment. That's a judgmental one. And there are another misstatement which you can say projected misstatement. Right? Now that is a misstatement. And the third topic is inherent risk. I am not looking any notes. I am just telling you that's the power. Right? That's the power of a good student, to know the concept, at your fingertip. You don't worry to look at any books in the exam. The inherent risk is what? The susceptibility, possibility. You cannot explain that without the word assertion. The possibility, let us say our example is impairment, that is a valuation assertion. PPE valuation is 50 million, right? Possibility that the valuation may be misstated, assuming that there is no internal control system, right? So that is inherent risk. Right now, this chapter talks about inherent risk, and then how to identify potential. Now, in my PowerPoint slide, I showed you the risk assessment process from understanding to things and assessing the risk. And the other one is control risk, right? I am not doing now here a theory lecture because this is meant to be a practical lecture, but I am giving you a revision. And please go back and watch the webinar that I did, True and Fair View, in detail, explaining everything, right? This chapter I am giving you by looking at 7 topics, I am just talking, but covering all the concepts. The control risk is that when there is inherent risk like impairment, what management is doing, management makes sure that the impairment calculation is properly checked by somebody that estimates the data, is checked to ensure that the data is reliable, assumptions are reasonable, and then there is an involvement of an expert if required in the impairment calculation, and then there is a proper review of the impairment calculation. Now this circle represents internal control. The control risk arises when this control either control is not there or control is not. Nobody is checking this impairment calculation. Somebody is doing, accountant is doing in an Excel sheet just by putting some assumption. Nobody checks, and that is a control risk, right? And then business risk is what I explained to you at the start here. So strategic, operational, and so on. And the other part is fraud risk, which I also cover as a part of this chapter. So now, if you take a very quick glance through of this chapter, I said true and fair view, you have to know FRF. Please read what FRF means, right? There are fair presentation framework as well as compliance framework. The idea of a fair presentation framework is to make sure as the name says, it allows you some flexibility that it's a fair presentation. Now, if somebody were now, it's very easy for me to explain fair presentation by explaining the opposite. Opposite is a compliance framework. You cannot deviate. If you want to prepare a set of accounts based on Inland Revenue Act, the tax, you have to follow the law. You can't have any deviation. But the beauty of a fair presentation framework, in rare cases you may deviate and justify why you deviate. And if you want to give disclosure beyond, that is also possible. So that is, this is what is explained in Roman 1 and 2. So, likewise, the compliance framework I explained to you, the misstatement I explained to you is the difference between what is recorded and what should be recorded based on SLFRSs. Then I mentioned to you there are 3 types of misstatement, right, all of this, and then we earlier looked at assertion session I did in very detail. All these topics have been listed, but yeah, inherent risk definition, IRF factors, you know, not to the level of new standard which is covered in the study text, but I recommend you to go through your auditing standard as well. And then there is a discussion on fair valuation, right, things like that. The fair valuation risk and accounting estimates point that I mentioned to you, right. So, the accounting estimate is a separate auditing standard, but simply you need to understand that auditor's duty is to ensure the whether estimates used are reasonable. So, that reasonableness comes when accounting estimate has been prepared again based on the SLFRSs. That connection is there. So, there is a separate standard on accounting estimates, right. Whenever there is estimate, like the same risk assessment process where auditor should obtain an understanding happens. So, the first part of the understanding is to understand the applicable accounting standard for the estimates. Let us say there is a share based payment, then you need to understand the SLFRS 2 says what is a share option. The option has to be valued at the fair value. At what date? The grant date. Without knowing that requirement, you can't calculate estimates. So, that is where the first point is to understand what the accounting standard requires, and then you should also understand the process, how management identify different types of estimates applicable to the company, how management estimates, how management makes the estimates. So, now that is an interesting term, how to make an accounting estimates. Now, if you want to estimate share option price, now if I ask you how to make a cake, you will see, okay, cake needs different ingredients, and then you should know the method of making cake, and everybody can't make a cake. You have to have somebody who knows how to make a cake. Similarly, you can apply the same analogy when it comes to making an estimate. If you want to make a share based payment, now I said the ingredients. What are the ingredients? The data, method. So, the ingredients for accounting, now making the cake, accounting estimates, you need to have data, that is the share prices, right. For example, you need to know the based on the share based payment agreement, how many people, right, number of shares, the prices, the current prices, how the price is going to vary in future. Now, when I say how the price is vary in the future, the assumption comes, and what is the method or a model that is going to be used. There are different methods, different model. For example, black school model, binomial model. Now, you need to really understand, right. Now, this is all about understanding. So, you need to understand data, assumption, method, model, and like I said, there may be expert, right, in doing this management expert, management. Now, let us say there is a CFA qualified person who did the valuation. In that case, probably you can say some level of expert, but not a true expert, because usually the term expert is used in auditing when somebody requires expertise other than accounting and finance, right. But this valuation can be seen still as expertise area, right. And then you also need to understand the internal control systems relating to preparation of share based payment, in this case whether it is just done by a junior person or done by a senior person and reviewed by the audit committee, and data has been checked. So, that means there is an internal control. Now, what I am explaining to you in 5 minutes is another auditing standard, 540 standard. So, that standard again is a risk based, where auditor understand these elements and assess the risk as high risk or low risk. So, those are the points. So, I am not doing a theory session to cover all of this, but now what I want to emphasize, the part 4 of this study text connects to accounting standards. It is very, very important that you thorough with different standards where the inherent risk is high. I can just top of my head tell you say 10 areas now, and those are very important. Now, say financial instrument, there are many areas where the inherent risk can be very high, especially let us say equity instrument valuation. If it is unquoted, the risk is high. Now, I mentioned financial instrument, then the impairment standards, even a PPE, the revaluation, right, and then if you take investment property standards, intangible asset standards, right, even provision is a basic standard that can give rise, and revenue is a wonderful standard where it can give rise to. Now, like that I mentioned 7, so I can keep on adding some areas to this list, meaning that those standards deal with account balances, transaction disclosure, which represent either complex balances. In a company, revenue recognition is complex, right, or uncertainty, or there is a subjectivity. So, that is where you need to connect accounting standards to this part to really to be able to identify risk. So, likewise, so the balance part of this chapter goes for a longer extent explaining different types of standards, right. So, now I do not allocate this time to cover accounting standards, right. So, I am sure Chandana sir would have given a very good coverage in terms of application of accounting standards, right. So, my duty is to explain to you how to use that knowledge to analyze a misstatement. So, for that purpose, I mean, now what I did probably take in about half an hour is to give you, is to activate, right, is to make sure that you understand the nuts and bolts, right. If you do not have this knowledge, I always say success of a student depends on 3 things. One is you should be very knowledgeable, any topic at your fingertip, you know what it is. You know what assertion, financial statement level, significant risk, what a control risk, what control environment, and then are you able to apply that, and are you confident to write an answer, right. So, this knowledge application writing KW matters a lot. So, now with that, now we are going to look at a case study, right. So, now this case study is in your study text, sorry, revision kit, because there are only very few papers, past papers, and but also you know with the syllabus change, there may be more questions in future which are case study types. Therefore, it is very important for us to understand the types of question that are there in the revision kit. There are several questions in the revision kit that you can potentially use. So, I am opening one case study which is a very long case study, and let me to type the name of the case study. Yeah, this Nandasiri limited case study, right. Now, in terms, I think in terms of page number, the question is in. I always say that this, if do not ever look at answers, right, you should always be very confident to write your own answers, right. So, let me, it's in page. This is the case study, and you can see these are very lengthy case study, like a pre-seen type of question, but you do not get such a holistic question only from audit section, but this analyzing this type of a case study will be really helpful for us from a longer case study. How do you take relevant information for the analysis, right. So, what we do is probably during this a very lengthy case study, right. So, during next half an hour or less than half an hour, we will quickly run through, and at the same time we will see how to write an answer. So, in writing an answer, one of the very important part is for you to identify. First of all, the first thing is understand the requirements of the question. Now, I invite you now, go to the end of this question and read what are the learning outcome examiner is testing. And for those learning outcome, there has to be an underlining topic, and you must know conceptually. For example, if this question says identify business risk, then you should have an understanding about what could be a business risk, what could be a business risk, right. Similarly, there can be another question from the business risk, identify what are the ROM or risk of misstatement, then you should know how to connect. So, likewise, first of all, what we are going to do is to understand what the requirement of the question is, and then we are going to read the case study to see how to gather information which relates to those questions, and as you gather information you should know how to convert these facts to an answer. So, that I call art of writing. So, which is what many students lack, the art of writing. So, let us start the case study, a very lengthy case study, but you know sometimes case study may have lot of unwanted information. Now, how do you draw boundaries as to what is unwanted and what is wanted? The best way to draw the boundary is not to read the case study, but go to the end and see what the requirement of the case. That is the beauty of case analysis. Then you are more focusing on what information should I specifically watch. Now, this is the trick. Now, we had required, now this is where you draw really boundaries, right. And okay, now let us see what these questions are. Part A. Evaluate business risk faced by Nandasiri Limited, right. So, the first concept which is being tested here for 18 marks is business risk, right. So, we have to identify business. Now, while every page in this case study I am very interested to know business risk. So, I go to whiteboard and write that after reading this case study I want a list of business risk, and then if I want marks I need to explain each of these risks, why it is a risk. Having understood the definition of business risk, remember any event, condition, action, inaction that can affect business objectives and company's ability to execute strategies, those are business risks. So, I will list down the business risk list here as we read the case study, and then evaluate the ROM, that is 14 marks. Now, let us say we put here business risk, right. I write now, first of all it is good to write the label. Now, for example, there is one business risk called competition and explain why it is a risk, like that. So, let us say we identify business risk. So, I wrote up to 7. And then logically there is a connection with part B of the question. This is part A of the question. Part B of the question says, right, evaluate ROM. You know what is ROM? Risk of misstatement. Evaluate risk of misstatement. Now, logical students or good students know that some of the answer that you write may come here, but the connection is that some business risk will have some financial impact and going to affect account balances, transactions, disclosures. Therefore, that can be explained as a ROM, and let us see how to do that. So, some of these answers can flow here. That is B, and I think those are the two questions, and then the case study has another section about the external audit side, and then it goes on to say at the end of the case study, again a second part of the case study, they ask identify and explain any indicators of potential fraud, 10 marks. Now, that is where this case study that I have selected covers another chapter in your syllabus, that is a fraud chapter. And then last part of part C, right. So, I will write here as a part of the same case study we have to identify FRF. What is FRF? FRF, fraud risk factors, right, indicators of potential fraud. So, let us say in simple word fraud indicators we have to identify. Fraud indicators, and good students should know, okay, this is the answer. Now, that is the power of good student. Now, fraud indicators are incentive or pressure, opportunity, rationalization. Now, see, but within few seconds the knowledge, right, like that. A good student will know this answer is absolutely easy for me, right. And then part D, evaluate possible implication of the circumstances and transaction noted in going concern. Now, see, again this same case study relates to another chapter in your book or another learning outcome. That is why I selected this case study in this session, because it gives coverage to different topics, and that is going concern. And again, now for your knowledge should be such that within 2 minutes every question that can arise from going concern you should know. That is my challenge to students, right. Now, if you say going concern, what can be tested in the exam? One is, as a part of risk assessment, auditor should identify events and conditions that indicate a risk of going concern in terms of financial indicators, operating indicators. If there is such an event identified, let us say companies making losses, or that the customers, they have lost the customers or lost the suppliers. Now, if such events and conditions are identified, then there is a likely conclusion that there can be MU. What is MU? Material uncertainty. When there is MU, the other part examiner can test is how MU is going to affect the audit report, right. The auditor has to conclude the going concern is an assumption. Whether going concern assumption is appropriately used or not, and your knowledge should be such that when there is a MU but still going concern is appropriate, but you have to make sure financial statement disclose certain things, and you must know what to disclose, disclosure 1, disclosure 2, and that is the beauty of the knowledge a good student will have. While there are some other students, they are wasting time searching the books where the answer is, and they are shivering in the exam time, I don't know where the answer is, and trying to extract and do all of that. A good student who has a very, understanding of the key words, the key term, right. While one student is searching for half an hour, that other student has written the answer in 15 minutes. That's the big difference, and that is why we see poor results in this subject for the, initial papers that were published. Therefore, be very confident. The more cases that you do from your own, this paper is absolutely, I can't disrespect the paper saying absolutely easy paper, but if you are ready, this paper is definitely not a challenge for you. But if you are not ready, if you take shortcuts, this paper is a challenge, right. Because I am talking especially about another element why this paper can be complex of corporate governance and audit element. But I am saying that will be very easy if you understand that as a holistic business topic, right. So, that is the, now we have identified the knowledge which is required. Now, it is a matter of reading and extracting info. As I extract, I just write it. So, at the end of reading, the answer is roughly built, and that is the beauty of case analysis. Let us do that now, and you have to do with me. Take your highlighter. We are going to go through about 5-6 pages in very quickly. Scanning, this is called scanning, because we remove unwanted thing, because we are only interested in business risk. And your thought process is that anything that is going to affect business objectives or strategies is going to be a business risk. And this risk can be, as we learn, it can be event, condition, or circumstances, or action, inaction. Now, see these words, event, condition, circumstances, and now you don't need to really classify in whether it's event or not relevant. Only thing you need answers. Okay, let us do that now. So, I hope this improved your confidence for any case analysis in any subject, but this type of case study, how to analyze, now we will see. So, the first thing is we are going to save time by not spending time on unwanted information, but wanted information. Let us start from the beginning, right. Now, if you glance through the case study, there is a background page about 1 full page. So, then those we can quickly run through. Then again this is a very strategic way of reading a case study, to look at what are the big headings. Then you should pay more attention into ISO this heading called current issues, because issues are issues and those issues can affect our case study as well. And then current situation, recent development. Now towards the end of the case study, very important, the numbers are so important, and those are the things that you have to look. Now let us take a critical view. So I am going to, based on the headings, skip or do very fast reading of the background, because the whole idea is to simply understand the, I think it's flying automatically out, background. Okay, now this company's history. So the company was established 30 years ago and has become one of the leaders in circuit board business. Now I am using some word and I recommend you to highlight as we read, and I hope, yeah, I hope there is a highlight. If not, I want you also to highlight certain words. So this company was established 30 years ago and has become one of the leader in circuit. Now their main business is circuit board industry. So this is important to know. The industry is a peculiar industry, unlike supermarket or any other known business. The technology industry. Now the moment we read that, good student will know one part of the business risk is the change, right, the technological obsolescence. Now that's how students connect to the knowledge. So the underlying circuit board industry, the business started as a wholesaler of circuit board components purchased in bulk from manufacturers, right. These components would then be separated and sold in a smaller batches to producers of circuit board, right. So these components then they are selling to smaller batches, right, to producers of circuit boards. The components would be, now you understand the business, right. So the initial business is wholesaler of circuit board, right. Components, they buy parts for circuit boards in bulk and then they are selling it to manufacturers of circuit board. Now remember, that is, if I write somewhere else, the word is business model, that's they are a part supplier initially, right. Then the component would be sold out according to specification of ultimate purchaser before shipping them to the, now ultimately this business is, this is the main industry, electronic equipment manufacturer. That's a very rapidly changing industry where the technological obsolescence is high. As a result, if you connect to risk of misstatement, risk like impairment, inventory obsolescence may be high. But let us see how subsequent information in the case study support that type of analysis. Then as the business grew, the company undertook the strategy of vertical integration. Now you see, this is a strategy that vertical integration is unrelated diversification. Vertical integration can happen upstream and downstream, right. So the upstream, let us see how upstream the supply, you can acquire your supply as well as you can acquire, you play a bigger part of your value chain to be more profitable. That's the idea of vertical integration. Firstly, by expansion into circuit board production industries. Earlier, they actually provided parts to circuit board producers. Now they are going to do circuit board production, right. By the acquisition of several circuit board production company, and now this is a customer acquisition, the downstream, right, integration. Now they are acquiring customers, right, and then this enable company to increase their margin and securing more avenues of sales. Likewise, they had the advantage of being able to purchase, so they were able to purchase from the supplier at a better price than their competitors in the industry, right, in this way, because now they are having they can probably, with one advantage of vertical integration is to give at a lower price. In this way, company was able to grow consistently. The second phase of the growth is further vertical integration, that is the acquisition of upstream. Now, this is earlier downstream, now upstream means you are acquiring suppliers. The acquisition meant company had the capacity to produce components that were previously purchased. Now, you do not need to purchase the components, right. Now, if you look at the business model, now earlier they were actually buying components and selling components, right. Now, they have actually acquired suppliers as well as they have acquired their customers. The business model is now strengthened through the vertical integration, right. So, that is a business model, and while you do that, there would have been a lot of investment money, and do they have proper funding, right. This is where when company invest money, they have to be very vigilant. This enable company to again increase the margin that they were able to make throughout the manufacturing process. The components that were previously sold on to circuit board producers could now be used for in-house production. So, all this in-house production within the previously acquired produce, the entire thing now they are doing. So, accordingly, do this strategy, you can see three divisions in this company. One is component manufacturing, right, and then the circuit board production from the component, and then sales and distribution. All of the circuit board manufacturing and production is carried out, the first two in Sri Lanka, and there is one larger component manufacturing plant in Colombo, which was purchased as a part of the acquisition from suppliers, right. That is the component manufacturing, and then company has two production facilities, one of which produces goods for export market. Now, you have to highlight this word export market, right. Why you highlight it? And other produces goods for the domestic market. About half of the goods are being exported, but the export market is suffering due to competition from a cheaper producers overseas. Most domestic sales are made under now after reading one page, we are able to pick some information for the business risk. Now, any company selling goods to export market is naturally exposed to one risk. Now, what is that risk? Because can you easily predict that you will recover X amount of price for the sale that you make, right? Your profitability as well as cash flow can be uncertain because of exchange rate fluctuation. The other part in the same paragraph, they say that the competition from a lower supplier, the cheaper products are very high. So, those two are business risk. Remember, currency risk as well as competition, and we should gather more information to support risk. Until we do that, let us write the heading currency risk as one risk. But you should be able to explain this currency risk, why there is a currency risk, right. And the second risk is to talk about competition. And for the time being, what we know is cheaper competitors, right, which means we can say when you expand the answer, you have to talk about there is a price competition. And so, those are now these headers are very powerful. Later it is a matter of expanding these headers to be an answer, and then going to the next page, current issues. I said this current issue part is very important. Yeah, one of the key materials used in the production is copper wiring. Now, in this circuit board they have to use copper wiring. All are imported. As a cost cutting measure in April, a contract with new overseas supplier. Now, they are signing a new contract with overseas supplier, and all of the companies copper wiring is now supplied under this contract. purchases are denominated in a foreign currency, but the company does not use forward exchange contract in relation to import of copper wiring. Very clearly, now earlier we spoke from selling point of view, now directly from purchasing point of view, now we can add more to our answer, right. Now, not only sale, now this is the part where you feed to the answer. Before writing answer, you can write some information which helps you to write the answer. Sale as well as their procurement, especially the copper from foreign currency, right. So, these are foreign currency, the currency risk, and it is not hedge. The main point which is also given in the case study is to say, especially these purchases are not hedge. Not hedge means you are exposed to the risk, which means you are not certain about the cash flow and the profitability as well. In recent years, Nanda Siri Limited has seen a pressure from several. Now, we should also see that there is there any risk with this new overseas supplier, right. Now, all of which is imported, all of which is important. One of the key material, all are important and cost cutting measure with the new overseas supply. Now, we have to see, you have to highlight this word and see, can there be a risk with this new supply selection? Have you done one key question to ask? Now, if you have a red pen, you will write here left side, have we done a supply evaluation? If it is a new supplier, how sure you are about the quality? One risk may be quality failure, one business risk. In recent years, Nanda Siri has seen a pressure from several factors that have made the business environmental challenging. The first factor has had a major impact on several new Chinese manufacturers. New entrants have come into the circuit board manufacturing industry. Whilst there had always been Chinese business in this market, these manufacturers had previously had a reputation for poor quality production techniques and a substandard product. So, previously these competitors have not been a challenge because their quality is not that great. But the second para says, however, the new Chinese entrants to the market have begun to produce significantly improved circuit board at a cheaper price, then definitely it is a harder time. Now, we gather more information. Okay, let us read the full paragraph. Whilst they are not of the same quality, they are now a realistic alternative for almost all the customers in the market. In terms of quality as well as price, the factor is compounded by the fact that many of the electric producers that contain company circuit boards, right, are also now manufacturers in China and must be shipped to that location. Now, see, now current customers are in China, you have to now manufactured in China, right. But now these competitors are also from China. Now, see here, circuit boards are now manufactured in China. Now, some manufacturing is done in China, we have to ship to the China, but these competitors have the location advantage. They are already based in China. Maybe their lead time, they are far better. Now, we see a bigger risk now. This risk information you can add to competition. It is not only price competition. Now, we can also write, there are new entrants, and new entrants are powerful not only in price but quality, and they will have better lead time. Now, I am taking all the information from the case study. Better lead time means they are based in China. So, therefore, there may be, reduction. Now, this competition can create a price war as well as companies' demand. Demand for the product can come down. Right now, I can easily write a paragraph and get 2-3 marks. That is how answers are written. Another major factor has been the increase in raw material and labor cost. Now, that is another risk. No, that is the event. The material prices and labor cost is rising. the cost of copper has increased significantly on the global market, and even with sourcing of copper wire from a new supplier, that is a cost cutting measure, the cost has continued to increase over the last few years. In addition, cost of employing local staff has increased, so that margins that were previously possible are becoming more difficult. Now we can write another risk, right? So that risk, another business risk, is the third one, rise in cost. I have to write in red color, rise in cost. Especially material and labor, and this has an impact directly on profitability. So the company is under real pressure now. The copper price, especially when we say cost of material, the copper price increases. Now we haven't hedged against the price increases, and also labor cost. In response, company has implemented now cost cutting measures. Actively, cost cutting is dangerous while it is a strategy. Now the cost cutting and also possible strategies. If you look at three strategies, one is they are trying to diversify. Now you remember, business risk can also arise from strategies, right? Now they diversify, they want to diversify, whether it would be prudent to diversify from circuit board into unrelated businesses such as property, totally different business, right? Property or hotel. Now one easy risk that you can say is that company does not have in-depth knowledge about this new industry, right? There is a high possibility of failure unless they strategize properly. Then best scope boards, right, that is where a potential venture of strategic change is away from the traditional business model, right. Now traditionally you order what you produce for customer, but now you create a website. Now this is a business model is changing. Remember, now this risk you can probably cover under change, right. This heading is under change or company strategy arising from strategy. Now here the business model is changing because they are going to create a website with the facility to enable customers to design, order and pay for their own circuit board. Now in this new business model, customer can actually design, order, pay. Now so the design part, all of that comes from the customer, and you have to manufacture according to that. Then they are going to further acquire a company. Now whether they can purchase one of those Chinese competitor, right. And at this stage, no decision has been made about this decision, any of these alternative, but a business case has been commissioned on each of the board and further draw conclusion about the best cost. Now here we do not have much information about this to write properly the answer, because nothing has been affected. If they say one they have finalized, then we can write the risk. That is where you have to be careful before writing everything as answer. Then financial reporting, right. Necessary prepare financial statement based on SLFR, not SLF financial reporting standard of that country. I mean, this is Sri Lankan company SLFRS, date is 30th November, they are year end. And you are an audit manager of Fu and company responsible for the audit, and taking over from the previous manager, you are a new manager, audit planning is in progress. Now you will expect similar question in your paper with the syllabus change that we discuss from auditing perspective, how to identify risk. Now these recent developments are very important with the background information. Early November, production was halted. Now this is actual risk. The production was halted for a week at the production facility that supplies domestic market. Why? A number of customers had returned goods claiming faults in the circuit board supplied. Why? On inspection, it was found that the copper used in circuit board, remember they changed the copper supply, right? Copper used in circuit board was corroded and therefore unsuitable. The corrosion is difficult to spot as it cannot be identified by eye and relies on electrical testing. Now this is dangerous. Now see, they have used copper as a component, and that is corroded, you can't even identify the corrosion. All customers were contacted immediately, and where necessary products recalled and replaced. The corroded copper remaining in inventory has been identified and separated from the rest of the copper. Now at this stage, I want your attention on this paragraph, which is a very important paragraph. Why? Why this para is important? Because this para talks about both business risk as well as ROM part, right. Now, one other thing, when we identified there is a new supplier, we did not write that as a risk, but we noted there is a new supplier, because they have as a cost cutting measure selected one supplier to produce copper, right. Now, this one supplier, now we can see how supply has failed, the corrosion has affected. So, now further risk you can anticipate from the supply. Now, imagine if supply is going to stop, because this is an overseas supply. Now, if there is some import restriction, export restriction from that country's side, it will not come. If there is a natural disaster or any such thing, the lead time or quality failure, now there is always a danger in relying on one supplier. So, therefore, you can easily write another business risk, which is called, sorry, I should have written in this in red color, supply risk. Supply risk. Now, in bullet points, you should be able to say why there is a supply risk. Especially, we are talking about copper supplier, and that supplier is an overseas supplier, foreign supplier, and then why do we worry about this supplier? Now, this is in your answer, you should explain these words, right. One is, now see, I want to write a sentence, and these are the words that I will use in the sentence. So, these are, I would say, power words. You can build an answer easily. Now, the power word for this answer, why I bother about this one supply is that one is there will be disruption. If something happened to this supplier, how am I going to continue? And then if this supply is going to increase the prices, what can I do? Right? There can be disruption, the price increase, those risks. And then it is the single supplier. The fact that you are only buying from that supplier is a major risk, that you have to maybe very high bargaining power, as a result your competitiveness is affected. Now, those things you can write as a business risk. Now, we can also write another business risk, that is, remember now, this company, while they are struggling, they are going to recall a product that has failed, the product failure due to corrosion. So, now here we can write another risk, which is a product recall. Now, product recall is a major risk. What is the major risk? It is not simply you are recalling the products that were sold. Imagine the news that goes to the market. Look, this company's product, we cannot rely. The quality is questionable, and that will pass as a negative message to potential or prospective customers, and that may affect the demand. So, therefore, remember product recall, when you write the answer, that has financial impact as well as reputational impact, and I am selecting out of all other risks to now go to the next answer. We can easily build this answer also now. Remember, that is the beauty where you connect business risk to a risk of misstatement at the same time. In some answers, if you have the overall answer structure in your mind. Now, what happens if there is a product recall? Now, if there is a business risk, that is going to affect financial statement, and that can be wrong. Now, in this case, product failure, how it's going to affect your balance sheet? Now, the products, whoever customers who purchase the goods, now you see they are electronic circuit board, this is electric industry, and they have done some electrical device. Because of this corrosion, there is major technical failure in that ultimate consumer, right? Like some, even some phone, there are famous phone brands that you are using, right? And the instances where those phones caught fire due to technical failures. Now, if such an event happens, is a disaster. Therefore, there is a possibility that the customer can sue. Sue means it can come to your balance sheet as a provision, right? Now, therefore, this product recall you can write as answer here, that can affect many assertions. As a result of product recall, now let us say I want to write this answer in more detail. What can I write? As a result Now see, I am simply writing an answer also, right. As a result of product failure, there is a possibility that customers may sue the company. So what? What assertion is going to be affected? So this may result in, this may necessitates, right, this requires, necessitates what? Provision, right. Now if there is a very clear case, provision can come, or a contingent liability, right, provision to be recognized or contingent liability being disclosed. Do not say contingent liability to recognize, it will be very sharp, it is a disclosure. Now see, one answer, I said there are multiple answers from product recall, another bullet point, you will get marks for these points. The other thing is, if you have already sold, in addition to this suing, there is a possibility you will not recover the money, that customer may not pay. So which means further, this may result in what issue? Collectability issues. Collectability issue. Be very confident about writing. Don't worry about whoever suggested answer, examiner's answer. As long as your facts are right, you will get marks. Your words, collectability issue. So what is the technical answer? It's impairment, right? There may be, this may result in collectability issues, right, affecting collectability issues, resulting collectability issues giving rise to what? Ultimate risk, giving rise to debtor's impairment. Now the risk is not over. You can write another answer based on the product recall, but because it's a big answer, we can write that as a new point. And let us see, while we read the balance part of the case study, we have more information to support, but already we have information. And at the start I said one balance where the inherent risk may be very high is inventory valuation. Now in this circuit board, because of the corrosion, now the case study very clearly says the impact of the corrosion cannot be spotted, which means there may be inventory affected by this issue, and those inventory you cannot sell at a normal price, you have to write them down maybe to zero or some scrap value. Therefore, there is a big risk that inventory may be overstated. So now you can write that answer also, you get marks. So what can you write? Because of the impact of corrosion, I am writing, I am erasing this going concern part, which we will anyway write as a separate answer. Corrosion, right? There is a possibility of having defective inventory, right? So end of the day, it's a defective inventory, right? This risk is increased, so this is aggravated or exacerbated, right? This risk is increased. Let's put simple word, this risk is increased due to the inability of spotting or identifying the effect. As a result, so what? Now your final part of the answer, as a result, inventory may be overstated as the real value NRV may be much lower than the cost. See, very powerful answer because of this effect. Now see how that, these answers very easy to write in your own word. Now if you want to explain this business risk, that the product recall arising from the corroded copper may result in drop in future revenue and legal action being taken against the company. Further, this will affect the reputation of the company and company's ability to generate revenue in future. That's the sentence I write. I don't need to again waste your time and for you to watch and write like this, but that you have to have the power of writing like I did these answers, right? So now, anyway, difficult one I will help you to write all, and then finally you can also run through the answer given in the book. But I always encourage, don't read answers, always build your answer and then check whether your answer is okay, or check in the suggested answer whether there is something you have to include, and that is how good students should think about answers. Now we came to product recall and did all of this. And let us complete the balance reading, because that is a key issue in the case study. And then work has recently started on a new production line. Which will ensure that the company meet new regulatory requirements prohibiting the use of certain chemicals which came to the effect. Now that is another business risk. Remember, when regulations are changing, it exposes company to a risk. And in July, company has taken a loan of 30 million at the interest of 4%, right? 30 million 4%, and it was negotiated with the bank. The main purpose of the loan is to fund the capital expenditure necessary for the new production line. 2.5% of the loan represent OD, right, which was converted to a long-term loan. Now this again gives you lot of information for the risk analysis. So immediately I can write one risk is new laws and regulation. Whenever there are new laws and regulations which are imposed, you can always write a risk. There may be a possibility, please write, there may be a possibility that the company may not be able to comply with such laws and regulations which may result in penalties. And if you want to convert the same answer here, you can write here, because such penalties can give rise to provision. So this you can write as the answer, but there is one more point arising from this, that is the loan. The loan we have to look at critically. I'll just write that in the middle, right, that this company is taking a loan of 30 million, and this 30 million at the interest rate of 4%. Right. So it comes to about sizable part. Now let us say this is it comes to about 1.2 million interest, right? And now if you say 1.2 million, look at the numbers. You have to be very keen about numbers. This company is already making losses. When there is a loss-making company, the 1.2 million is a significant amount. The current financing cost also very high, and the conditions are very bad. The profit is down. All of that. Are they able to, now the interest cost alone is a big amount. Will they able to pay that? And the fact that part of this is a OD. The other one, if you are very skeptical student, you will go beyond this. Remember, the heading is new production line. And here can you, right now this new law, the company has created a new production line, but this can go to another risk in your financial statement. A new production line, what are the risks that you can have? You can have two risks. One is PPE. The fact that you are doing a new production line means there is a possibility that some of the expenditure, now what is the big topic now? When you are building a new production line, only those expenses of capital nature you have to capitalize. And then because this company is not doing well, the revenue nature they can capitalize, right, as a fraud risk factor. And the other thing that we know, that this is where you have to really relate accounting standard, case 23, borrowing cost. This loan, the main purpose is to fund the new production line, therefore the relevant interest cost can be capitalized, it may not be done. So, those two risks you can write here. Now, I will erase as I write more points here, right. So, now another risk that you will write is a PPE valuation. Why I am writing that? Because of new production line. So, what are the points that I should write under this? I can write 2 bullet points. Please write with me. I am dictating the answer so that you can write. One answer that you can write here is that straight to the answer without wasting your words. There is a possibility of inappropriate, because this company is anyway under pressure, inappropriate capitalization of expenses of what nature? Revenue nature. Right, there is a possibility of inappropriate capitalization of expenses of revenue nature. Now, within bracket you can confidently say this is a fraud risk, because they are trying to, there is another part of fraud risk, I will explain this in more detail. Now, this is, they are under pressure, right. So, then they will try to do some manipulation, especially when there is a new product, go and park some of the revenue expenses here, right. And the other one is further, the loan appear to have taken to fund the production line, I write PL, and it may and the new production line and the production line PL may be a qualifying asset. Most probably it's a qualifying asset, because you can't suddenly put, no, it takes necessarily a long period of time to get ready for its intended use. As a result, right, you can capitalize borrowing cost, right, qualifying asset, right, where the borrowing costs attributable, not all the cost, right, borrowing cost attributable should be capitalized. So, the risk is this may not be done. That is another answer. See, we wrote another answer, and then if you are a skeptical student, you will write another answer, right. Now, when there is a new production line, the obvious question that you need to ask, what is happening to the existing production line? So, the existing production line may not be available, may not generate revenue, therefore, it need to be impaired. See, another answer coming. Now, while we wrote PP evaluation, second PP evaluation answer comes, that is impairment of existing production plant. And you can easily say why it need to be impaired, because obviously with the new production line, the existing line may not work. Now, you see how answers are coming, and let us look at now several answers came because of that point, and then look at the balance information, bespoke boards, that is the other part of website and things like that. As a part of their strategic plan, the Nandasari started to develop a website for sale. Now see, a very good accounting student will note, now immediately I can go and write the answer by looking this word, developed a website. Now if you look at it as an accounting issue, this is SIC 32, SIC is not SIC, Standard Interpretation Committee 32 talks about the issue of can we capitalize, I will erase some of this now, can we capitalize website development costs. That is the issue examiner is trying to test. Developed a website for sale which was completed and available for use from May to 2002. The website has the facility for customers to design their own circuit board and to choose products they need and make a payment. Now then you see this said website, now the original thinking of why websites are used, the issue is that the websites are used for marketing, right, or advertising, generally speaking, not traditionally. Therefore, can you capitalize marketing and advertising? No. But nowadays, website has become a part of revenue generation model, and in that case you may justify capitalizing website development cost. That is the answer, but anyway read the information. The total cost of the website is about 2 million. Now definitely whenever they say 2 million, 5 million, you can calculate. Now remember there is another session called materiality. You should know when there is some cost, 2 million divided by total asset, right. Total asset value I am sure is given here. The total asset of this company is about 180 million. Out of 180 million, 2 million, 2 divided by 180, is it material, right. So if it is less than 1%, it may not be material. So you have to check that, but usually as an issue you can write here. Yeah, this is website. After initial development, the operation of the website including collection of payment from customer, Now see, after website, collection of customer was outsourced to specialist company. Now this you have to be very careful when companies outsource as a business risk. Now this outsource can fail. Now when any failure in outsourcing service provider can affect customer confidence, or there can be a fraud. Another business risk that you can write here is two risks. One is a website risk, other one is outsourcing risk. Company prices have been reduced. Now see, even after website, the company's prices have been reduced roughly by 10% for online sales. Online sales prices are less by 10%, which by the end of the year made up about quarter of company's revenue. Now quarter of the revenue from the website, it is significant. The revenue has gone up, but the price has declined. So isn't that a business risk? Yeah, it is. And then further it says, we will read next para also to see how information can support. The website initiate. Now this is what I said, website is a part of value chain. Initiate fulfillment process automatically once the payment has been made by the customer, working on the basis of the information entered by the customer. Company has, now website is all doing automatically, right, fulfillment, everything. Company has outsourced final delivery. Now we know cash collection, delivery, everything outsourced to courier company, outsourcing part. Company, now this is the problem, company has experienced some difficulty with the website, including relatively high rates of return from the customer. Now this is the issue, the website, now there are customer returns, there are also errors in goods delivery arising from customers' misunderstanding of the website. Now there are sales returns, errors, all of that happens because of website. Now the issue we discuss in these two paragraphs, can we convert to an answer? Definitely yes. Unfortunately, I may have to remove some of these points for me to continue to write the answers. So before I remove, I will tell you how you should complete this answer, because my idea is to give you the confidence where you build your own answers, right. There, what can you write for currency risk? The answer, right, I am using these power words to build answer, right. What can I write for currency risk? Especially the bigger part of the risk, more than the sale, the purchase, I would say. Of course, sale also there is a exposure, right. So, what can you write? Because, or as the company has exposed to currency risk, right, both in export sale as well as purchasing copper, right. So, now what is the issue? The adverse fluctuation of exchange rate may affect what? Profitability, cash flow. Profitability, cash flow, and currently this is not hedged, also mentioned that, therefore risk is high. So, that is the answer. You see, be very confident to write your own answers, and then same answer I want to convert to this side. So, therefore, I am removing some part of now this we have written of PP valuation, impairment, all of that. So, I will erase that part and convert this currency also to answer. Now, this currency risk, how can I is it now? Obviously, if it affects profitability, it is going to affect the financial statement. But remember, whenever you write a ROM, connect to accounting standard, and now we know there is LKS 21, right? What is the risk that we are facing? There are two risks that you can explain. One is translating. One risk is the company may not translate foreign currency using the spot rate. As a result, the exchange gain or loss may not be properly recognized. The other issue is LKS 21 requires what? This is all you are using accounting standard knowledge to describe the issue. Now, if they do not use the spot rate when there is a foreign currency, obviously exchange gain or loss is affected. The other issue is, remember, at the month end, right, you have to convert what? Monetary assets using the closing rate. So, your receivable, payable need to be adjusted to the closing rate. And if that is not done, again it is affected, especially now in this case there is a creditor. Further, monetary assets, example creditors, payable, trade payable need to be translated using closing rate, and this may not be done. I mean, any case study, this is the answer that you will write. Now, a complicated case study would be, let us say they have hedge used in a forward contract, and now you are accounting for derivatives, and then you are trying to apply cash flow hedge. And this is a complicated case. Then you have to see the hedge effectiveness, whether hedge is a part of risk management, the disclosures, those new risks comes. But in this case, they haven't hedged, and that is that. Now, because I have explained to you this, I can erase the currency risk part. I am completing the answer now. That is what I am doing. The second part of the answer, we also should write an answer explaining the supply chain risk. Now to write that answer, what information that I have, sorry, this is not the supplier, this is the competition. I want to write another answer about the competition. So what can I write? The words are already inside the answer. If I write a sentence here, what I am writing, please write with me. The competition of the industry, right, has been intense. Intense means significant, right, severe. This is mainly due to the low price quoted by the customer for fairly high quality items, and that suppliers' ability to do faster response because they are based in China. As a result, what will happen? Companies' volume as well as price, the company sales revenue will come down, right? Revenue may come down. So, there is a pressure on profitability. And then I will ask you a question, can we convert this into can competition be converted to a ROM? Answer is yes. And that is where in the same case study they want us to write fraud risk factor. So, definitely this competition can be written as a fraud risk, because when there is a competition, remember this word I explained to you, fraud triangle, there is a pressure for the management to manipulate the accounts, right. Now, here I have already written within bracket this competition, sorry, I erased that point earlier I wrote, right. So, that competition part also I explained to you. Then I will also complete this answer. I mean, this is a very easy answer to write as a business risk. The rise in cost of material and labor, right, may further affect companies' profitability and their ability to compete with the competitor. Now, I will erase up to that point because I am going to write some new answers based on what we discuss now, right. So, after I just erase this part because we have already written that, I am now the part that I was explaining to you from the now this heading bespoke boards, the two issues that are given. One is the website that they have developed. It's good way they have developed a website, but they have given some issues with the website. So, what issues have they have explained? One is that there are customer complaints, right. Yeah, now it's in this page. So, the website is automatically handling everything, but the current issue is that company has experienced some difficulty, including the relatively high rate of returns from the website, and there have been errors, returns, errors, all of that. Now, that is where you see website. Now, this is a good example. Remember the explanation of business risk. Business risk, I said, here I have written here. Business risk can arise from what? Business risk can arise from an event, condition, circumstances, action, inaction, right. Now, this is a business risk arising from a change. Change is what? The website. What are the risks of the website? Now, several bullet points you can write. As a result of website, web, right, which is contributing, now it is a significant part of the revenue now, which is contributing to a significant part of revenue. Now, you can say it is mentioned that currently about 2/3 prices reduced by 10%, and it is about 1/4 of the sales is from the website, right, as a result of web, which is contributing following risk, right, following risk following risks have materialized, they have already happened. Now, some risk already happened, but you can write some more risks. Now, what is materialized already, right? Drop in prices by 10%. Now, you have to see whether the revenue increase is sizable against the price drop. The other one is sales returns, errors due to misunderstanding. Now, these are actual risks that has happened, but remember, the other risk is that when you are a global player, if you sell through internet, there may be what? There may be tax issues. Now, whether you are liable to pay taxes in other countries when you collect it, and the biggest risk further, web can give rise to what? Cyber security risk. So, which means there can be attack through internet. Now, while all these points are relating to website, we can easily write one answer. I am removing the currency answer here to write another ROM based on the website. How website is going to affect financial statement, and that is the topic, capitalization of website development cost. Website development cost, right? Now, this is, there is original issue has been discussed in SIC 32 and the relevant standard is LKS 38, right? So, in this case, can the website be considered as internally generated intangible asset, right? So, the issue that you need to highlight, whether the cost incurred can be capitalized as an intangible assets, right. So, to the extent, now what the answer that you can write, the amount, now you may not be able to just capitalize everything, you have to really analyze the purpose of the website. Yes, in this case it is used for as a part of revenue generating model, then based on the principles or the criteria given in, right, this could be considered for capitalization in terms of the conditions in LKS 38. However, company should be able to prove that the website is a part of the business model and facilitate revenue generation, right. And then another clause you have to add, however, the cost incurred should be analyzed, the different costs, for example, some hotel bills, things like that, also they have capitalized. The cost incurred should be analyzed to see what can be capitalized. So, therefore, this involves element of judgment and may not be properly done. The other part, now I do not know how many, we have written so many issues, right. The another issue that you can write is outsourcing, right. So, the let me write here the risk of outsourcing. So, I will remove this cyber security risk that we have already written. The other part is, because of outsourcing, can there be risk? Definitely, whenever you outsource, there is a risk of outsource party can fail. As a result, customer confidence can be affected and the cost. So, I will just write those are very simple risks, right. Customer delivery can be affected if there is a failure in this outsource, and because the cash collection is outsourced, there can be fraud risk. And also, sometimes because of the cost, you have to really see whether outsource is the better option compared to internal cost. So, those aspects you need to analyze when it comes to outsourcing. Now, we are coming to the latter part of the case study, right. There are the website part we discuss other matters. Several companies, executive directors and financial controllers left, and they are going to set up another company specializing in recycling old equipment. The company is not considered to be in competition with Nanda Series Limited main operation. The directors left on good terms. Replacement of the directors have been recruited. Now, can there be a risk because directors have left the company? Of course, they are saying in the case study they haven't gone to a competitor, but the fact is, remember, the directors are important to run the day-to-day operation and to make decision. If some of these key directors are not there, company's decisions may not smoothly happen, which can affect the ongoing production operation or the marketing. So, therefore, there can be business disruption, business effect because they do not have those directors, right. So, that definitely you can write as a risk, other business risk. Directors leaving the company, and then if we do not know why they are leaving, if they are leaving for some fraudulent reason in the company, that again will indicate a fraud risk in your answer, right. So, the other part is to talk about, but directors leaving the company. So, I will write as another risk, some directors leaving the company. So, your point directly to say that although such directors have not joined competitors, that is what the case study claim. There may be business, there may be an impact on making critical business decision in the absence of such directors, which is a business risk, right, and they can't properly govern, etc. And now we are left with information in the case study, I mean financial information, which some part of it we looked at. And one of the things that you can definitely write in your answers to say that we have already written under competition that the profitability is low and they are now making losses, and the fact that the financing cost has remain constant, that we have to check whether it is okay because they have taken that new loan. And then if you calculate, if you want to do remember analytical procedure is another part of your syllabus topic. I recommend you now here, if you do a simple analytical review, you can compare the revenue drop that has happened and the operating margin, what the margin is, and the net profit margin, things like that. Then the draft financial statements have not been prepared, but MO states that the total asset 180 million. Now, this is where we check some material or not. The cash book balance is 130,000, the cash balance, right. And based on the draft figure, company's current ratio is 1:1. So, now this is where you have to really question that with the new loan that they are going to take, that it will affect their gearing further, and that will impede further capital raising in future. Now, actually we have discussed these two, now this is what I said when I analyzed the case study. At the end of your reading, answer is done now. Now, we have actually answered both part, part A and B, evaluate the business risk as well as evaluate the risk of misstatement, we have answered, right. So, in terms of completion of the answers, see, I mostly explained to you, all of this even by writing. Some of the financial statement is now, some of the things that I put here, if you again want to explain. Now, we wrote a supply risk. Now, how to write this as a sentence or paragraph, right? What is the risk with supply chain? Now, before writing that paragraph, I am checking what are my power word. my power words are such that there is currently a supplier from foreign country, copper supplier. I have to explain that if something happens to that one supplier, I am in trouble, and if that supplier's prices are going up, I am in trouble. So, I will write one paragraph. You can write, what can I write? You can say that as a cost cutting measure, company has changed the supplier and now sourcing all copper from one supplier. This may result in the risk of disruption if there is any failure from the supplier delivery, and remember this failure on account of, it can be because the supplier in a foreign country, it can be because of regulation, there is a prohibition of bringing material to Sri Lanka, or it can be due to delay in port, or it can be due to weather condition or any such thing. There can be failure that happens, and that if this supply is going to increase the prices, it will affect my prices. So, finally, what you can say is there is a single, now this is another way, another heading for this answer would be single customer, single supplier dependency, right. Now, when you depend on one supplier, you are always vulnerable if supplier goes bankrupt. What can you do? So, therefore, there is a necessity to develop alternative supply. So, that is the answer you can write for that. Product recall we discussed. The laws and regulation, you have to simply say as a result of new laws and regulation, you know, that can affect company's ability to continue, which may result in penalties, all of that. Then we discussed several financial statement risk. So, now this is a very lengthy case study, right. There is another part of the case study which specifically talks about the fraud risk. Now, already I said, now we talked about competition and there is a pressure. Now, if you want to write the balance part of the answers, we can further analyze this in terms of the fraud risk and then write the answer. So, I think before we get into that part of the case study, I will just run through the answers that I wrote and the answers which is in the book. My purpose is not definitely to not to compare and say why this is there, this is not there, but to tell you that okay, whether we have covered everything, and also to show you that don't try to write to a very lengthy, don't try to write lengthy answers like given in this suggested answer. Keep your answers very short, but of course the suggested answers may be important for you to see whether there are anything left, you know, anything that you have missed out, and for learning point of view definitely it is very important, right. So, now see the points that we discuss. Now see this very detailed answers are given. See whether the points, especially from business risk angle. Overseas supplier. The copper wiring is a key production material which is imported from overseas. Therefore, there is a risk of unstable supply. Unstable. Now, what is the word I use? See, use your own word without any fear. Disruption in the supply chain. It may be transport, long, anything, right? Political issue, regulatory issue, whatever. So, that is a supply chain risk. And then we spoke about currency risk, especially purchasing, but I also explained to you it can be sales, right. So, the risk, and this is currently not hedged, it can affect the profitability and cash flow. And then they have put the supply as two issues, but we discuss as one issue. Here the issue is there is only one supply. Now, I said if one supply, I even word this as single supply dependence. If something happens, you know, there is companies in problem. And then competition. This is where we discuss, you know, the competitive industry, price competition, companies unable to compete, and we also said their cost is rising, and then there are alternative manufacturers at low price, and definitely there is a quality issue that we have to, we discuss this under product. Under product failure, we discuss as a sub point the risk of reputation. Remember, if you want another heading, you can say reputational risk arising from quality failure, because the fact that the copper resulted in corrosion, this is going to affect, this may suggest that the company is producing poor quality items, this will affect future demand. And then there are new regulations that have come and that company may not be able to meet. Now, this is a new loan, which put further pressure to their finance, because now this is very important, this part I want to show you. Always in the exam, try to use this syllabus concept like materiality. Now, 30 million is the loan, and if you look at whether loan is significant, 30 million divided by the asset, I think about 160, that comes to about 16% of the total asset, therefore it is material. And then I said this 1.2 million cost compared to the loss is significant. So, the key thing is the fact that they are now running with a loss, the management may not be able to pay this loan, and that can create some going concern issue, right. Again, because going concern is a separate part of the second part of the case study, I did not explain as a totally separate point. And then the several executive directors have left, and I said, I mean, this can affect companies, ongoing operation, and they have the business expertise. And the website issue we discuss. So, what are the risks that we discuss? There can be tax issues we discuss, and then the brand image may be affected, and the other one is cyber security risk that can be there, and then the high rate of return is a problem, and then this part also we discuss, price reduction, all we have discussed, right. Then the outsourcing is another risk, because the outsourcing company can fail, right, and their service may not be a quality service. And then the profitability is dropping, obviously that can be obvious. Now, in terms of ROM that we discuss, remember whenever you explain a risk of misstatement, you have to draw attention to the accounting standard LKS 21, and then according to LKS 21, how you have to convert non-monetary items and monetary items, and especially I mentioned in this answer 2 points. One is you have to use the spot rate to convert foreign currency transaction. Other one is monetary items should be valued at closing risk. But this answer also suggests another thing, that non-monetary items are not recognized. That is also a remote risk. Yes. Then product recall is a big point that we should write. The LKS 37, there may be provision, right, product recall, and then we also said that there may be receivable collection issue, impairment, and the new production line we discussed, one is a capitalization issue, revenue expenses may be capitalized, and I connected this to a fraud risk, and then I said the borrowing cost directly attributable need to be capitalized, right, and then we said all the one need to be impaired in terms of LKS 37. A big answer is that inventory valuation obsolescence, that the corroded copper, and this is complicated by the fact that we can't identify, then the inventory should be valued at cost of NR, which is lower. The other part that I explained to you extensively using the SIC 32 guideline, here there is no much explanation. It simply says that website should be based on the LKS 38, and then if it is feasible you can capitalize. But then if I explain to you going beyond this answer, according to SIC 32, if you prove that the website is generating revenue, and then you can capitalize those relevant expenditure, and then there is a possibility of capitalizing unwanted expenses. The other thing is website sales. I think this I didn't specifically mention, that the outsource party, right, the website sales are likely to be material, and then there are a lot of issues, and this suggests, now this is a very good point for internal control weaknesses, right, because if website has issues of capturing proper sales, it will affect sales completeness, because as a result all sales may not be recorded accurately and complete in financial reporting. And then going concern, obviously there are indications why I did not discuss this, because this is a part of the separate question, and I think that is a separate case study altogether that we need to analyze. And I am sure to make this session shorter session, and let us take the balance part where it talks about the fraud risk and a going concern, right. I would like to spend that, because it is an additional part of the same case study, just a very simple part without spending much time, taking about another half an hour we can discuss. But I really recommend you, now you understood the art of case analysis, right, any case study, what we did today, right, we first refresh whether you are knowledgeable and whether you can recall key concepts very quickly. And then what we did, when you look at any lengthy case study, you went down and see why I should read the case study. That is the requirement of the question. And then you quickly skip unwanted information and see wanted information. As you find information, you start putting down one by one. And then labels only. Then when the case study describes that label in more detail, then you allocate in your answer script itself that I have some powerful word to describe my answer. At the end of reading, you have all little words written here, then you convert that to answer. And then we also learned today how to connect business risk to risk of misstatement. So the other part of the case study is, this is very, I mean, if you look at the time given for this case study, about 90 minutes, but we analyze, but this type of same 90 minutes question are not there in your paper. It is probably a part of a longer case study. But the balance part, I recommend you, before you watch next thing, make sure what you have to do today, right, as a part of revision. I recommend you to go through that key chapter, true and fair, in much detail, including the fraud section. And the going concern I have already done in the previous one. Then we will take the other part of the case study and see how to answer, and probably to do one more section, right. So with that, we bring this session to a close. I am sure that these are the type of sessions which are very important for you to be able to build your confidence, that you can use your own words and write your own answers. Thank you.